Welcome to this episode number 35 of your next trade, called today the Magnificent 7. Last week we discussed the end of the quarter, end of the month, and we underlined the fact that the winners may probably keep on winning, meaning the leaders that we have seen over the last 6 months could have seen a strong performance going into the end of the quarter. So now, just to recap what has been happening in H1, I would like to be looking at the two major indexes in the US, which will be the S&P 500 and the Nasdaq 100 here. Looking in terms of points, this is not ideal. Normally, I would be looking in terms of percentage, but to give a better understanding of what has been happening in H1 and what has been the market breadth and how the market has been mostly driven by 7 names. So, what about those 7 names? So, if we look at the S&P is up year to date at the end of H1 by 611 points, and roughly we got 468 points that are coming from those 7 names. I'm taking Alphabet in 2 because you get 2 listings, but overall that gives you the indication that 77% of the S&P performance is coming from the those 7 names. If we look now at the Nasdaq 100, NVDA roughly made 16%, Apple 15%, Microsoft 13%. But overall, if you take the Nasdaq 100, which was up more than 4,000 points over the last 6 months, more than 3,000 points or 78% of the move can be explained by those 7 names. So as long as those market leaders, those strong names are going higher, the picture is more or less the same. So what about the year-to-date asset performance at the end of June now? We got the S&P up 16%, Nasdaq 30%, so more or less twice more than the S&P. Europe is still pretty strong with the stocks 50 up 16%, Nikkei very strong, so Japan up 27%. Keep in mind that if you look at the other end of the spectrum, looking at the currencies, the Japanese yen has been weakening by 9% versus the US dollar. So always when you look at performance, don't get confused and always put the performance against the same currency, because otherwise that could be not giving you the right numbers. Crypto very strong, 83% for Bitcoin and 60% for Ethereum. For the commodities, WTI, oil down 12% and copper down as well by 2%. So what about the week-to-date asset performance? We've seen a week ago that we had some weakness after the option expiry, and that is very much explained often when after the expiry there is a window of weakness. Why? Because people are repositioning with options again, but after this weakness, the market has been extremely strong the whole week. So 2.3% for the S&P, Nasdaq the same, the Russell as well very strong. So overall risk on. If we look at stocks, FX not moving much, flattish on the week, so dollar and versus any currency waiting for more catalyst going forward. What about the year-to-date industry performance? I'm interested in the S&P, which is here, and so this is the S&P. You get the outperformers, so that would be the plus, and here you get all the industries that are underperforming the market, and as you can see, most of the industry, let's say 60-70% of the industries have been underperforming the market. So as we said into the during this introduction of this video, and as we have been underlining over and over, the market is very much driven by very few names. You see here that semiconductors are up 50%, technology, home builders, so very few sectors driven this market, which makes the performance pretty hard unless you have been big overweight in these sectors. What about the week-to-date industry performance? Mostly green for the week, a bit of red with biotech, and as always when you get a risk on, the bonds are not performing that well, or the gold, which was flattish. Oil services, transportation, airlines, real estate very strong. So that tells you that this week has been mostly about a bit not even a recession going into H2, but more like the US economy will do well into the second half of the year. So a lot of expectations that the US economy will do better. We had the US GDP, which was revised up, and that was on Thursday, and the market really liked it. So on the sector's performance, looking at the year to date here and looking at the week to date, as you can see, the week to date where you get the S&P here, real estate doing well, materials, industrials, energy, all those sectors will be cyclical. And again, that tells you that at least for this week, the market has been pricing a US economy doing better, and that the odds of a recession into H2 will be very low, and actually that the US economy will still be growing. My view is still the same, and we're going to be looking at it a bit into details, is the same. So I think in H2, the US economy actually will be struggling based on the idea that the US consumer is running out of reserves, or the reserves that were built in 2020 and 2021. The story is still the same. The market is very adamant that the US economy will do well. What about the rates? Looking at the picture, so US 10 years roughly at the same level. So as you can see, this is the chart here. I don't like to be doing too much of charts on yields, but that gives you the picture. So we are trending around the 360, 380% for the 10 years. So not crazy moves. So China, sorry, was a bit of a mismatch. But the yield curve, which has been a bit confusing to say the least, because, over the last recession, that has been a good leading indicator. What people are missing here is this leading indicator could take quite a long time, 18 to 24 months. And I think, to me, the picture, again, is still the same. We're going to be running into more trouble going into H2, and you can see as well that looking at the US GDP, which was mostly driven by one-offs in January of this year. But if you look at the retail sales since the start of the year, retail sales have been flattish in the US. So what about the Fed expectation? And I think this one is important, is still important. So the peak rate, the terminal rate in roughly around November, so that will be when the Fed will be at the end of the hiking cycle. So the market is expecting 5.4.1% versus the 5.07 that we have these days. So that's roughly 34 bips. So that gives you 1 to 2 rate hikes until the end of the year. And that will be then, rates going lower. What is interesting, if you compare the last, which was on Friday, yesterday, versus what were the expectation a month ago. So if we look at the December, for instance, you see the change from 492 to 539. So roughly we are talking 50 bips. So over the month of June, market was really strong for stocks, and in the meantime, despite so market was strong despite actually market pricing 50 bips hike change between the two. What about if you look further down the line? If you look at June here, June differential is roughly by 87 bips. So that's more than, so that's 3 to 3.5, 25 bips. So what is the rate market pricing is the Fed having inflation coming, but as well an economy that is doing fine. So versus what we had a couple of months ago, no rate cut into H2, economy doing well, and that is explaining a lot of performance into the risk on. The VIX 30.59%. So you see the trend. We broke the level here, and since then we have been coming down, and volatility is coming down. I think this is still a function of a lot of products that are short dated maturity from the 0 day to expiry to 1 day to expiry, but there is a lot of selling pressure into the volatility. So volatility is compressed, and that amplifies as well the risk on that we've seen over the last few weeks. Let's jump now into the technical analysis, and because this is the end of the month, I would like to change a bit the color, looking at the monthly. So here, if you go into TradingView, you can change and put it on the monthly, and that gives you the candle for the months. And looking first as the S&P futures, we identify the 4200 level. and we have been moving much higher since then. I'm not going to be lying. My positioning is still the same, both on the Europe and the US. So I've been running some shorts. So performance has been a bit of not great. So I'm flattish for the year. But this is the strong candle that we have. If you look at the Nasdaq picture, it's the same. We had 4 months of strong move. And what is interesting is that was the March here, which was the issues that with the regional banks, and since then we had a risk on those names, mostly out of those 7 magnificent. So don't get me wrong, the market breadth is bad. Not that many, let's say, active fund managers are making money. Why? Because it's mostly driven by 5 to 10 names. The Russell picture is the same. We are still trending into the same level despite a strong end of the month. Russell, Nasdaq versus the Russell, still the same picture. Still the same picture for the 7 magnificent. Very, very strong since the start of the year, and there has been an acceleration from March onwards. If you look at Apple, the picture is the same. New highs. It's a 3 trillion market cap company, but the trend is very much the same. The one that is not looking great is the regional bank. I know that the Fed, I know that many players are telling you it doesn't really matter. I think it will matter again. Regional banking, if you think about it, that makes a lot of the financing, the local financing, roughly 30% of the US economy. And if they are struggling, the financing going into those regional, with the regional banks into the local is going to be an issue. Emerging market, mostly with China making 50 to 60%. Not much of a move, not much of a direction so far. Looking at Europe now with the stock 600, we have been consolidating for a few months now. I think in terms of catalysts for both the DAX and both and the French market, for instance. So DAX, what has been interesting in terms of economy, because macro matters, the German economy is flattish these days, not really growing. The leading indicators are telling you that not much is happening. If you look at France, actually the week has been pretty bad. So a lot of riots, and normally you'll see riots. Yes, I can understand that structurally there is something wrong with France, but you can as well explain that when we've seen the same kind of phenomenon in 2012 or 2013 when the economies were going into recession. So for Europe, I'm still the same. I'm still bearish. WTI, same picture, not a great picture. Same with the copper. It's not that bullish. What about the euro dollar? We have been consolidating for months now, at least for the last 6 months. Dollar yen picture, something that I've been telling you for months now. Dollar yen, you need to be looking at the differential of rates between the US and the Japanese 10 years, and the picture is as long as the Bank of Japan is very accommodative and controlling the Japanese 10 years around the 0.4%. The Japanese yen is weakening. What has been interesting for this week is actually we've started to see some politicians in Japan saying that might be the time to intervene. And if you remember, or if you don't remember, when we were last time around 145, so that was at the end of last year, this is the time when the Bank of Japan started to intervene. So they intervened on 145, they intervened on 151 something, because I was short around 151, and that was what had helped the part of it to explain the strengthening of the dollar yen later. What about now? We jump into what has been happening for the week. So end of the quarter, one direction. So instead of using the S&P futures over the last 5 sessions, here I'm looking over the last 11 sessions. So here, this is the OPEX, this is the expiry. We had the first week where we get this range, we coming down, and then we broke higher, and we had the acceleration going into the quarter and the half year, and the month's end, mostly driven by the same names, as I said, the 7 Magnificent, because of the window dressing, because of volatility being compressed, because of as well a lot of inflows going into ETF and passive investment going into those very few names. And then yesterday on Friday, you had a bit of acceleration on the way up based on the PCE. So we had the PCE yesterday, which came out at 4.6% for the core year on year, plus 0.3% month on month. So it was a bit lower. I think the market, was just, looking for even if the numbers would have been bad, I think the market will have go higher. Don't forget that we got the 4th of July coming on Tuesday, and very often you get the hoo-ha-ha going into the 4th of July. But if you look at the PCE here versus the Fed funds target, we should have, the Fed staying around this level. So now that the inflation is much, much better, what you can see looking at Apple here, this is the chart here, looking at Apple versus earnings. So everyone is telling you, or maybe he's telling you that earnings have been much better. That explains a lot why the market should be where it is now. So if we look at this chart where in white you get the price of Apple, okay, which is making new highs. So this is the close of 193 and 194 for Apple. But in the meantime, if you look at the blue, this is the EPS for 2023 expectations in dollar terms. Okay, so as you can see in blue here, that has been coming down and it's roughly around 6%. But what is interesting is over the last 6 months, it has been coming down. So what the market has been doing, it's not with better earnings, it's about the multiplier going higher. So if you look at PE, either your earnings go higher or you are using a higher multiplier. Now, if you look at the S&P, we are probably for this year around 18 to 20 times. So by no means the market is cheap. By no means the earnings over the last 6 months have been better or have been on the way up. So don't get me wrong, it's not because the US economy is doing better, it's not because the earnings are doing better, it's just because the market is much more is keener on paying a more expensive multiples. What about the catalyst going forward? So 4th of July on Tuesday, so that means probably Monday is going to be a bit of quietish, low volume at least, because people in the US will be taking a long weekend. But we're gonna have an interesting catalyst with the ISM manufacturing in the US, manufacturing PMIs in Europe. Then on Thursday, we get the ISM services in the US, but that will be Wednesday for Europe. I didn't calculate the SPY weekly straddle, so do a bit of looking at the straddle. This is not the right number. Not much of earnings. We got Levi's on Thursday, FOMC minutes on Wednesday, but mostly it is about those leading indicators, which are both the manufacturing and services. We do know that manufacturing has been a bit of a struggle. Services have been coming down a bit recently versus expectations now of the market really pricing the US economy doing pretty well in H2. So what about the seasonality going forward? So here this is for the S&P looking at July. If you look at the recent performance in July since 2015, the market has been very strong. So I think there has been a bit of putting a lot of position going into this start of July with good expectations with artificial intelligence, the numbers getting better, and the seasonality really is good for July. But now I'm interested, the same as I did for Apple, looking into the earnings. I'm looking at the S&P Q2 23 expectations. So this is the trend that we've seen, going down and down and down. So on the one hand, you can argue that the expectations have been lowered quite a lot, so that will make it easy for the market to beat the expectations. But anyone telling me that actually the numbers have been strong, that earnings have been on the way up, this is just not true. If you look at the S&P 2Q EPS, so the market is now pricing $52.78 versus $53.4 in Q1, so that's down 1% quarter on quarter, and that will be down 8% year on year. 8% year on year. So that is literally a big number coming down. And I know again what the market is through the price action is telling us is Q2 is probably the lowest, the low level, and then we're going to be picking up in H2. I don't think this is, I mean, my view is still the same, which H2 is going to see the US consumer struggling. So this is the view. I've been wrong so far, pretty wrong. As I said, in terms of performance, flattish for the year. So as always, if you are interested in what we do, join the trading community. We are on Discord. We got 3 channels that are for free. We have more channels for people who have done either the 4x4 video series and or the mentoring. If you like what you've seen today, if you like to put a comment, that helps. And overall, this is the new month's new quarter, H2, and we are obviously mostly looking at the earnings that will be starting roughly with JP Morgan on the 14th of July. So this is it for me today. I hope you enjoyed it, and I'll probably see you next week. Bye bye everyone.